What's up, guys? I'm Jeff Montgomery and welcome to Tax Planning on the Whiteboard. In part one of this two-part series, we talked about the why and the how of Roth conversions, and in this video we're going to talk about the pros and cons. Just to remember, if you like what you hear and you want more whiteboard videos, just click that subscribe button below. And again, quick disclaimer, this is not specific information to anyone watching the video. I want you to use this as general information and education only. Please don't implement any strategies you see or hear in this video without talking to your tax professional first. Okay, this all sounds great. Everybody's doing Roth conversions. They are all the rage. What are the pros and cons? There are many proponents with many different articles written about the benefits of Roth conversions. Everybody should consider Roth conversions. That's what they say. Well, the pros are pretty simple. If you think about your tax rates in retirement, if you think they're going to be 1% higher, it may make sense. Many folks say that, hey, wait a second, Jeff, I'm going to be in a lower tax bracket in retirement, not a higher tax bracket in retirement. Well, are we really sure about that? Let's think about that. If you have 10 to 15 years before you're ready to retire, we have no idea what future tax brackets could look like. Also, many of our deductions are gone in retirement. Your house may be paid off. You don't have a mortgage interest deduction. Your children are grown and they moved out of the house. No tax deductions there. You're retired. You're no longer contributing to your 401k. Some of these deductions could have totaled $50,000, $60,000 or more per year. Now we're left with our standard deduction. Also keep in mind, in a traditional IRA, in a rather large IRA or 401k accounts, you have 10 to 15 years before retirement. Let's say you're 60 years old, and that money can grow over that time. At age 72, under the current law, you have to start taking withdrawals from those accounts. Some of these accounts could be extremely large right at the time when you're forced to take money out through required minimum distributions. Think about potential tax rates in 10 to 15 years if you have that gap and how large that IRA may be. Some of those taxes could be exorbitant and at higher future rates. So if we go to the whiteboard, let's illustrate this using the popular Rule of 72 as a guideline. Okay, if we go to the whiteboard, we're going to look at the Rule of 72. And now, I'm not talking about the required minimum distribution age of 72. What I'm talking about is, what if we could average, hypothetically speaking, 7.2% per year in growth of our IRA? What if that was possible? Now, I gave you an example earlier. So let's say we had 10 to 12 years, maybe 15 years, before required minimum distributions are expected to start. Currently, tax law says age 72, the year you turn 72. They give you a little grace period till April 1st of the following year. But let's just say we had 10 to 12 to 15 years to grow this account. Now, let's just talk about if you have a rather large IRA and what a required minimum distribution would look like at that year. So let's say, hypothetically speaking, we have a 401k or an IRA account, whatever you want to call it, something that's pre-taxed, and it's worth $1 million, okay? And let's just say your current age, for simplicity purposes, is 62. So now the Rule of 72 says that if we can earn 7.2% on average, our money will double in 10 years. Okay, double in 10 years. That means that $1 million at 7.2% will be worth $2 million at age 72. Now, what happens at age 72? We get a knock on the door from the IRS, and the IRS says, hey, guess what? That account that has been growing tax deferred for all these years, it's time to pay the piper. Now, we know what the tax rates are right now, today, and the different tax brackets. We don't know what the tax rates will be in 10 to 15 years. But at this time, we have a $2 million IRA, hypothetically. What would be the minimum distribution on that account? Well, they just changed the required minimum distribution tables for this year. But if we take that $2 million and we do the calculation based on 2022 RMD tables at age 72, we have to divide that by a factor of 27.4. What that leaves us is a minimum, folks, minimum distribution of $72,993. Minimum distribution that we have to take out. And guess what? We have to pay taxes on that money. So that money is all taxable because it has been growing in that tax deferred account for so long. Could that trigger taxes on other sources of income? We're going to take a look at that next. So what about the bad? What are the cons of completing Roth conversions? Well, number one, any money converted and transferred from your traditional pre-tax IRA into your Roth IRA will most likely be taxed in the year of the conversion. Most people don't like that. They don't like voluntarily paying more taxes than they have to. It's a very hard decision to make. We are so trained in our society to think micro in terms of taxes. How can I save taxes this year? Most accountants talk about focusing on how to save taxes in that tax year, thinking small. We want you to think macro. How can we save taxes over a lifetime? So there's a lot of pros, and we're going to kind of do a little old Ben Franklin and do pros and cons, but there are also some things we need to be careful about. Number one, once you do a Roth conversion, they cannot be undone. They used to call that recharacterization. No longer available. It could also trigger taxes on other sources of income, like your Social Security. When you do a Roth conversion, taking money from a traditional IRA to a Roth, that is considered taxable income and can trigger taxes on your Social Security. It can also, if you do large conversions, possibly increase your Medicare Part B and D premiums through a IRMA surcharge. So if we go to the whiteboard and we summarize the pros and cons, it kind of looks like this. Okay, let's do the old Ben Franklin. We're going to draw a line down the middle of the piece of paper, and we're going to do pros on one side, and we're going to do cons on the other side. And we'll see what we can come up with on whether to do a Roth conversion and what to think about. Well, let's go ahead and start with the con column here. Number one is most likely it is going to be taxable. Now, I say most likely taxable because depending on other sources of income, it may not be taxable. Depending on deductions, it may not be taxable. But chances are, most likely, doing a conversion from a traditional IRA to a Roth IRA is a taxable consideration. Now, again, we want to focus on macro. Do we save taxes over a lifetime? Do we know or do we have an idea what tax rates would be in the future compared to our current tax rate? Something to think about. Number two, as a con, they cannot be undone. They used to be able to, I guess in a sense, have a do-over. So you have to complete a Roth conversion by December 31st of the year that you want to do that conversion. That income would most likely be taxable for that year, the year of the conversion. But you cannot undo the conversion the following year of the conversion that you did the year before. You used to be able to do that. They used to call that recharacterization. That is no longer available. They cannot be undone, so it is an irrevocable decision. Keep that in mind. Number three, they could trigger taxes on other sources of income. The main one I want you to focus on is Social Security. So if you are already at Social Security age and you are collecting, or maybe you started collecting Social Security early, right now the earliest you can collect is age 62, collecting your own benefit, and you do a Roth conversion, you have to see if that will trigger taxes on your Social Security. It could trigger taxes on up to 50% of your Social Security or up to 85% of your Social Security based on what's called a provisional income calculation. We're not going to get into that on this episode today, but keep that in mind. It could also increase Medicare Part B and D payments. All right, Medicare Part B and D payments. Now, they never used to be income tested, folks. So Medicare Part B and Part D is now income tested. And there's actually brackets depending on your modified adjusted gross income. So when you look at those brackets and you look at your income, if you do a large Roth conversion, which would increase your adjusted gross income, that could trigger taxes on Medicare Part B and D. That is properly called IRMA, Income-Related Monthly Adjustment Amount. So keep that in mind. That could be a con in some situations. Also, what if you are not above Medicare age at age 65? By the way, for IRMA, they look at income from 2 years, so you'd really have to look at your income starting right around age 63 if you're going to start Medicare at age 65. They look at 2 years in the past. But what if you are, I don't know, on the healthcare exchange? So you are on you're getting health insurance from ACA and you're getting a premium tax credit. You have to be aware of the ACA premium tax credits because those are based on income. So you could actually eliminate a tax credit by doing a Roth conversion. So if you are on the healthcare exchange, you're getting your healthcare and you're getting premium tax credits in that situation, you have to be aware of that as well. Now let's go back up here. Let's look at some of the pros. So number one, I think, we all know the pro of having a Roth is tax-free distributions. All right. Now, I'm going to say tax-free qualified distributions, okay? Just to be a little bit technical here. In order to have a tax-free distribution, we have to adhere to certain rules in a Roth IRA. The number one is the 5-year rule. We're not going to go into the 5-year rule today, but just keep the 5-year rule in mind. But if we follow the rules and we have a qualified distribution from a Roth IRA account, it's tax-free. There are no, as of current tax law, no required minimum distributions on a Roth. So imagine in that same example, if we had a $1 million Roth IRA and we utilize the rule of 72, hypothetically making 7.2% on average per year, over a 10-year period, that $1 million Roth would be a $2 million Roth, all tax-free. Keep that in mind. So no RMDs. You are not required to take out money from your own individual Roth IRA under current tax law. So again, if tax rates double, some people out there predict tax rates could double. If you have most of your money in the Roth IRA, not a big deal. 2 times 0 is 0. Okay. It does not trigger taxes on other income like a traditional IRA would do. So when you take money out of a Roth IRA, it does not trigger taxes on Social Security, for example. So it is not part of the provisional income calculation that determines whether 50% or 85% of your Social Security is subject to income tax. So that's kind of an important benefit there. Also, withdrawals do not affect your Part B Medicare payments. So they don't affect Part B and Part D Medicare payments. So that is an important benefit as well. So if you have a large Roth and you take a large amount out, you don't have to worry about your Part B payments going up. It gives you tremendous tax diversification, which we really love that idea for tax diversification. And I think one of the last benefits is for non-spouse beneficiaries inheriting a Roth IRA. So we're going to say non-spouse. And actually, let's use the technical term. They call that a designated beneficiary inheriting a Roth IRA. Let's say one of your children inheriting a Roth IRA. That money will be tax-free in inheritance as well. Now, they will still have to adhere to the 10-year rule when they inherit a Roth IRA account. In other words, they have to have that money out within 10 years, the 10-year rule. However, as I mentioned on a previous video, the really smart ones would leave it there for 10 years and not touch that money and let it have another 10 years of tax-free growth. Could you imagine that? If it was a $2 million Roth and another 10 years at 7.2%, that money would double to $4 million in that example, all tax-free. But it has to come out by the 10th year. Just kind of keep that in mind. And this would be for non-spouse designated beneficiaries, not eligible designated beneficiaries, designated beneficiaries. So folks, that is it for this episode of Tax Planning on the Whiteboard. Again, consult your financial advisor, consult your tax advisor about any strategies you might hear on today's show. If you like these videos, please click subscribe button. I want to continue producing this content, and we'll see you next time.